I am Sally. Welcome to Sally Krawcheck Retires. And I have to start today's video with something that is going to feel a little uncomfortable. The IRS does not send you a welcome to retirement card. They do not call you to say congratulations, here is everything you now owe us and everything you must now do differently. They just quietly expect you to know the rules. And if you do not know them, they send you a penalty notice. That is how it works. So today, I am going to do what the IRS never does. I'm going to walk you through the 10 things the IRS fully expects you to handle the moment you retire. These are real rules with real deadlines and real dollar penalties attached to them. Most people miss several of them. Some people miss all of them. And by the end of this video, you are going to know every single one. Let us go. Number 1, update your tax withholding immediately. And I mean the day you retire, not next month. Not when you file your taxes in April. Immediately. Here is why this matters. During your working years, your employer handled your tax withholding automatically. Every paycheck, they took out a portion and sent it to the IRS on your behalf. You never had to think about it. Retirement day comes and suddenly that automatic system disappears. Your income now comes from different sources. A pension, Social Security, IRA withdrawals. And none of those sources automatically withhold the right amount of taxes for your specific situation unless you tell them to. If you do nothing, you are likely going to underpay your taxes throughout the year and get hit with a penalty plus a surprise tax bill in April. The IRS calls this an underpayment penalty, and it applies when you owe more than $1,000 at tax time and did not pay enough in during the year through withholding or estimated payments. The fix is straightforward. If you have a pension, file a new W-4P with your pension administrator telling them how much to withhold. For Social Security, file Form W-4V to have federal taxes withheld from your benefit. For IRA withdrawals, you can elect withholding at the time you take the distribution. Do this the day you retire and you will not get an ugly surprise in April. Number 2, set up quarterly estimated tax payments if withholding does not cover everything. This is the piece that trips up more new retirees than almost anything else. If your combined withholding from all your income sources does not cover your full tax liability for the year, the IRS expects you to make quarterly estimated tax payments to cover the difference. Those payments are due 4 times per year: April 15th, June 15th, September 15th, and January 15th of the following year. Miss those deadlines and you face an underpayment penalty on top of whatever you already owe. The Safe Harbor rule says you can avoid penalties by paying either 100% of last year's tax liability or 90% of this year's tax liability through withholding and estimated payments combined. If your income last year was over $150,000, that safe harbor amount bumps up to 110% of last year's tax bill. Use IRS Form 1040-ES to calculate and make those quarterly payments. This is one of the most overlooked IRS obligations in the entire first year of retirement, and it catches people completely off guard every single time. Number 3, know exactly when your first RMD is due. RMD stands for Required Minimum Distribution. The RMD age right now is 73. Anyone who turns 73 in 2026 must take their first required minimum distribution. And here's the specific rule most people do not know. If this is your first RMD year, you have until April 1st of the following year to take it. But if you delay your first RMD to April 1st of the following year, your second RMD is still due by December 31 of that same year. That means 2 large distributions in one tax year, which could push you into a much higher tax bracket. Most financial planners recommend simply taking your first RMD by December 31st of the year you turn 73 to avoid that double hit. And if you miss your RMD entirely, the penalty is 25% of the amount you were supposed to withdraw. If you catch and correct it within 2 years, that drops to 10%. But even 10% on a missed $20,000 RMD is $2,000 gone for doing nothing. Know your date. Take your RMD. Do not let the IRS remind you. Number 4. Report every income source on your tax return, even the ones that feel small. When you retire, your income picture gets more complicated, not less. You may have Social Security income, a pension, IRA or 401k withdrawals, interest and dividends from savings accounts and brokerage accounts, maybe a small amount of part-time work, maybe rental income. The IRS receives a 1099 or W-2 for every one of those sources, and they match that information against your return. If you forget to report something, even something that feels small and insignificant, their computers will catch it and you will receive a notice in the mail asking for the taxes on that unreported income plus interest plus possibly a penalty. Every 1099 for retirement account distributions. every SSA 1099 for Social Security, every 1099 INT for bank interest, every 1099 DV for investment dividends. All of it goes on your return. Create a folder starting January 1st of each year and drop every tax form into it the moment it arrives. This habit alone prevents one of the most common and avoidable IRS headaches retirees face. Number 5. Understand how much of your Social Security is actually taxable. This one shocks people every single year. Most Americans grew up believing Social Security was a tax-free benefit. They paid into it their whole lives and they fully expect to receive it without the IRS taking a cut. But that is not how it works and has not been how it works since 1984. Depending on your total income, the IRS can tax up to 85% of your Social Security benefit. Here is how it works. The IRS looks at your combined income, which is your adjusted gross income, plus any tax-exempt interest plus half of your Social Security benefit. If that combined number is between $25,000 and $34,000 for a single filer, up to 50% of your Social Security may be taxable. Above $34,000 as a single filer, up to 85% is taxable. For married couples filing jointly, those thresholds are $32,000 and $44,000. The reason this matters so much at retirement is that any money you pull from a traditional IRA or 401k increases your adjusted gross income, which then drives more of your Social Security into the taxable column. A retiree who takes an extra $10,000 from their IRA to pay for a vacation might accidentally push thousands more of their Social Security benefit into taxable income than they expected. Understanding this interaction before you take large distributions from retirement accounts can save you real money every single tax year. Number 6, claim the new $6,000 senior deduction that most retirees are missing entirely. This is brand new for 2026. The One Big Beautiful Bill created an additional $6,000 deduction per person specifically for Americans who are 65 or older. For married couples where both spouses qualify, that is $12,000 in additional deductions on top of the standard deduction they already receive. To be eligible, your modified adjusted gross income must be under $75,000 as a single filer or under $150,000 as a joint filer. This deduction phases out above those income limits, but for the millions of retirees who fall within those ranges, it is a genuinely significant tax reduction that most people have not heard about. It is available whether you take the standard deduction or itemize your deductions. If your tax software is not automatically flagging this for you, or if you are using a tax preparer who has not mentioned it, bring it up directly. The IRS is not going to call you and remind you to take a deduction you are entitled to. That is your job. Number 7, handle your first year of Medicare and understand how it affects your taxes. When you turn 65 and enroll in Medicare, your Medicare Part B and Part D premiums are income-based. The IRS system that determines your premium is called IRMA, the Income-Related Monthly Adjustment Amount, and it looks at your tax return from 2 years ago to determine what you pay today. So, the income you reported on your 2024 tax return is what Medicare is using to calculate your 2026 premium. If you had a high-income year in 2024 because of a large IRA withdrawal, a home sale, or any other one-time event, you may be paying an elevated Medicare premium right now, even if your retirement income is now much lower. The good news is you can appeal that determination by filing Form SSA 44 with the Social Security Administration and explaining that your income has changed. Many retirees pay elevated IRMA surcharges for years without ever knowing they had the right to appeal. If your income dropped significantly when you retired, file that appeal. Number 8. File your taxes even if you think you do not owe anything. Many retirees enter their first year of retirement with the genuine belief that because their income dropped and they may owe very little or nothing in federal income tax, they do not need to file a return. That is often wrong and can be expensive to be wrong about. If your gross income exceeds the filing threshold for your age and filing status, you are required to file regardless of whether you think you owe anything. For 2026, the standard filing threshold for a single person age 65 or older is approximately $16,550. For a married couple both over 65, it is approximately $3,700. Even below those thresholds, there are situations where filing is in your financial interest. If federal taxes were withheld from your pension or Social Security, you may be owed a refund that you will never receive if you do not file. If you qualify for the Earned Income Credit on part-time work income, you need to file to claim it. The safest approach is simply to file every year without exception and let the math determine what you owe or what you are owed. Number 9. Keep your beneficiary designations updated and tell the IRS through proper estate planning documentation. This one is not a direct IRS form to file on retirement day, but it is an obligation with enormous tax and legal consequences that most retirees handle poorly or not at all. IRS Final Regulations TD 1001 confirm that non-spouse beneficiaries who inherit retirement accounts must now take annual distributions in years 1 through 9 when the original owner had already started RMDs and then empty the account completely by the end of year 10. That is the new inherited IRA reality. And the person whose name is on your beneficiary form on the day you die will face those rules whether you intended them to or not. If your beneficiary form is outdated, names an ex-spouse, names a minor child without a trust in place, or has simply never been reviewed since you opened the account 20 years ago, the tax consequences for your family could be significant and completely unintended. The moment you retire, pull every retirement account you own and verify every beneficiary designation. Primary beneficiary, contingent beneficiary. Check them all. Update anything that is wrong. This takes 30 minutes and can prevent decades of financial and family pain. Number 10. Understand the 5-year rule on Roth conversions before you make your first one. Many retirees hear about Roth conversions in retirement and immediately start converting large portions of their traditional IRA without understanding a critical IRS rule that applies. Each Roth conversion you do starts its own 5-year clock. If you withdraw converted money from your Roth IRA before 5 years have passed since that specific conversion, you owe a 10% penalty on the amount withdrawn, even if you are over age 59 and a half. Now, your regular Roth contributions and their earnings have a separate 5-year rule that works differently. But each conversion has its own 5-year seasoning period, and most people doing Roth conversions in retirement are completely unaware of this distinction. The practical implication is this. If you do a Roth conversion at age 65 with the intention of having tax-free money available for a large expense at age 68, be careful. That converted money is subject to the 5-year clock, and depending on the timing, you may face a penalty if you need it sooner than expected. Plan your conversions with this 5-year rule clearly in mind, and make sure any converted money you might need in the next 5 years is either left in the traditional account or funded from other sources in the meantime. So let me bring all 10 together for you right now, fast and clean. Update your withholding the day you retire. Set up quarterly estimated payments if needed. Know your exact RMD date and take it on time. Report every income source, no matter how small. Understand how much of your Social Security is taxable and how your IRA withdrawals affect that number. Claim the new $6,000 senior deduction if you qualify. Appeal your Medicare IRMA surcharge if your income dropped at retirement. File your tax return every year even if you think you owe nothing. Update every beneficiary designation on every account. And understand the 5-year rule before you do your first Roth conversion. None of these things are complicated once you know them. But every single one of them carries a real financial consequence if you ignore it. The IRS is not cruel. They are just consistent, and their consistency means the rules apply to you whether you know them or not. If this video saved you from at least one of these mistakes, please subscribe to Sally Krawcheck Retires right now and hit that bell icon so you never miss a new video. Every week, I cover the retirement rules, the tax traps, and the financial strategies that real Americans actually need to understand before it is too late. If you know someone who just retired or who is retiring soon, share this video with them today. These are the 10 things nobody sat them down and explained. Until now,